In the 1960s, there was a show called The Twilight Zone. It was a TV series created by Rod Serling, which has been described as a strange mix of horror, comedy, drama, science fiction, and superstition. For many, 2022, you may have felt like you were actually in an episode of The Twilight Zone. For investors, it was particularly difficult as well because both stocks and bonds lost value, historically rare, not normal. Shaken and confused, you might be wondering if 2023 will be different or a repeat, or have we entered into another episode of The Twilight Zone? There may seem like there's no rhyme or reason to last year's investment experience. I'd like to offer an alternative point of view. Hello, I'm Jonathan Bever, Head of Research at Fulcrum Wealth Advisors. Last year may have felt like an episode of The Twilight Zone because we're going through an economic paradigm shift. The Fed did an aggressive series of rate hikes as inflation measured by the CPI and PCE deflator reached high levels and remained there. What that means to you and I is the cost of living got expensive, which we know. This should not be such a huge surprise, however, as it follows one of the Fed's most aggressive stimulus cycles, with the rates near zero and an expansion of their balance sheet called quantitative easing. Amplifying the volatility in risk assets was the shift between aggressive economic stimulus on the one hand and aggressive economic restriction on the other. So many may be wondering if 2023 will be a repeat or different. Let me address some of the few points from my most recent blog titled Outlook 2023 Valuation Pendulum. We're going through a paradigm shift after 13 years. The Fed has had a policy of having low Fed rates for a long time, which are going higher for years to come, in our opinion. The Fed has also used their balance sheet expansion called quantitative easing to provide more stimulus, which we believe has come to an end and will be used only in cases of emergency. The cycle of 40 years of declining Treasury yields has also likely come to an end, and we will see the Treasury yields go higher for years to come, not linearly, but in fits and starts. Lucky us. The valuation of risk assets went from high to much lower, resulting in poor performance across various investment strategies, passive investing, indexing, buy and hold. The popular strategy of set it and forget it, which gained popularity for years, did not work so well. In our opinion, we have entered into an investment climate that will be more difficult to make returns for years to come. Essentially, the ability to borrow cheaply and have relatively easy returns is over. It can be confusing to hear the arguments from the bulls and the bears. The bulls are suggesting a return of 25% on the S&P, while the bears are suggesting a possible decline of 25%. Guggenheim Partners in a recent report suggested the S&P could decline to 3,000 to 3,200. Our own research, we conclude a probable return of 5.7% for the S&P for 2023. We're not as much concerned with the argument by the bears because the markets could decline 25% in any given year. We just do not think it likely to occur this year. On the other hand, the bulls are suggesting a 25%, which we think is far too aggressive and might tempt the investor to take their risk management hat off, and that's not prudent from our perspective. Your strategy, whatever it is, so what do? We're suggesting a return to fundamental investing. What is fundamental investing? Fundamental investing requires hard work and a lot of research. Now more than ever, we believe it's a time to return to a longer-term perspective. On our website, you can read my whole blog regarding the paradigm shift Outlook 2023. I'm Jonathan Bever, Director of Investments at Fulcrum Wealth Advisors. You can also email me directly with your questions at john.bever@fulcrumwa.com.